Ladies and gentlemen, good day and welcome to Q1 FY22 earnings conference call of HDFC Asset Management Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. From the management team, we have Mr. Navneet Munot, MD and CEO, Mr. Piyush Surana, Chief Financial Officer, and Mr. Simal Kanuga, Chief Investor Relations Officer. I now hand the conference over to Mr. Simal Kanuga, who will give us a brief, following which we will proceed with the question and answer session. Thank you, and over to you, Mr. Simal.
Thank you so much. Good evening, everyone, and thank you very much for getting onto this call. Our presentation is available on our website as well as that of the exchanges. As usual, we'll start off with an update on the industry and then follow it up with our company. We'll open it up for questions after that. The first quarter of the current financial year has seen healthy inflows into equity-oriented funds. As against an outflow of rupees 84 billion in quarter ended March 21, this quarter saw net inflow of rupees 251 billion. We have seen reversal in trend from the month of March 21, and that continues as we speak. The interesting thing that we have observed is gross equity flows. The average monthly gross flows for the financial year ended March 21 was rupees 237 billion. As against that average monthly gross flows for the first quarter of the current financial year was rupees 337 billion. Average monthly redemptions, which were at rupees 290 billion in last financial year, dipped to rupees 253 billion in this quarter. Debt funds saw outflows of rupees 20 billion, while liquid funds witnessed inflows of rupees 95 billion. Others, which include ETFs, arbitrage funds, and funds investing overseas, continue to see healthy inflows. Individual folios, for the first time, has crossed 100 million mark and is at 102 million as of June end. Individual AUM is rupees 18.3 trillion, with 70% of that in equity-oriented funds. B30 AUM continues to be at 16% of the overall industry AUM and 27% of equity-oriented AUM. SIP flows, as you would all know, for the month of June 2021 was rupees 92 billion. We will now move to our company. We closed the quarter with AUM of rupees 4187 billion, market share of 12.4%, with quarterly average AUM of rupees 4169 billion, market share of 12.6%. For reasons mentioned in earlier calls, we also present market share in AUM data ex ETF. Our market share in quarterly average AUM ex ETF is at 13.7%, while on closing basis it is at 13.6%. In terms of actively managed equity-oriented AUM, our market share stands at 12.9% on QA AUM basis and 12.6% on closing AUM basis. At this point, it would be pertinent for us to mention that we recently concluded a sectoral NFO, Banking and Financial Services Fund. During the quarter, we had also launched Asset Allocation Fund of Funds, which has seen healthy response. Our market share in debt is at 14.5% in QA AUM and 14.7% in closing AUM. In liquid, it is at 15.5% and 15.9% in QA AUM and closing AUM respectively. We continue to have a favorable asset mix as compared to that of industry in terms of higher proportion of equity assets. 57.9% of our AUM comes in from individual investors. Comparable number for industry is 53.7%. We continue to enjoy highest market share in individual AUM, and that stands at 13.5%. We process systematic transactions adding up to rupees 9.8 billion in month of June 2021. The number we report is on actual cash flow basis. For the quarter as a whole, we received inflows to the tune of rupees 28.3 billion through systematic transactions. When we are on topic of systematic transactions, we would like to highlight an interesting campaign we ran in month of June. We called it Nurture Nature and committed to plant a tree for every new SIP that got digitally registered in equity-oriented strategies. We planned the campaign around the World Environment Day and ran it for a couple of weeks. The results were truly encouraging and saw strong interest across the country. Our B30 market share of 11.5% makes us a distant number 2. On the digital front, we are making some material changes. We have recently refreshed our mobile app. simple and powerful, and the feedback we are getting on the same is truly encouraging. I think rather than stating what all we are doing, it would be good for us to update all of you as and when we get done. You will definitely hear much more from us on this. We continue our journey in creating a state-of-the-art digital infrastructure and leveraging on the same for enhancing customer experience. We now move to financials. The company has shown an improved performance during quarter ended June 30, 2021 as compared to corresponding quarter in 2020. Revenue from operations increased due to an increase in AUM as well as more remunerative mix with higher percentage of equity AUM. However, during the quarter, company incurred additional business promotion expenses. Since such scheme-related expenses are accounted for in the books of the scheme, they result in lower management fees to the company. The company has also seen some dilution in margin due to reduction in total expense ratio in some equity schemes due to increase in their size. Other income was higher this quarter on larger book size and mark-to-market gain on investments. In February 2021, a grant of ESOPs was made to certain employees, and the expense head employee benefit expense includes the pro rata amortization of the fair value of these ESOPs as required under India's accounting framework applicable to the company. This is a non-cash charge which is not tax deductible and is book value neutral. In quarter 1 FY22, this non-cash charge amounted to rupees 176 million. Besides this, employee benefit expense also showed increase as the company resumed its practice of annual increments in employee remuneration after taking a break from the practice last year due to COVID-19 pandemic. The disallowance of certain expenses and higher tax on company's investment income has contributed to the increase in company's tax rate. We now move to financial highlights for the quarter. The numbers for the quarter are as follows. The operating profit of the company for quarter ended June 30, 2021 was rupees 3652 million as compared to rupees 3006 million for the quarter ended June 30, 2020, an increase of 21%. Profit before tax for the quarter ended June 30, 2021 was up by 23% to rupees 4661 million as compared to rupees 3804 million for the quarter ended June 2020. Profit after tax for the quarter ended June 30, 2021 was rupees 3454 million as compared to rupees 3024 million for the quarter ended June 30, 2020, an increase of 14%. Our operating margin now stands at 35 basis points for the quarter ended June 30, 2021 as compared to 34 basis points for the quarter ended June 30, 2020. We would now like to open up for questions. As Nirav announced, we have both Navneet and Piyush here. We'll be happy to take questions if any. Nirav, we can open the line for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Shalija from Concept Investment. Please go ahead.
Thank you. My first question is, what is the target equity, non-equity mix for the next 2 to 3 years?
Hi, Shalija. We do not have a target as such, but you would have noticed that our share is better than the overall industry share. Our overall equity within the overall assets is higher than the rest of the industry, and we would love to see that going forward.
Okay. My second question is, like, we've been seeing a continuous decline in our market share for over a year now. So what do you think is attributable for this fall, and what are we doing in response for this thing?
So I think Simal has mentioned earlier, first of all, when you look at the market share, the more relevant data to be seen would be the data on the slide 8, which is the market share excluding ETF, because you know that the ETF AUM has over 80% of the AUM from 2 AMCs and also from the government disinvestment program and the PSU debt ETFs. But of course, we have seen marginal decline in the market share ex ETF AUM as well. But we wouldn't read too much into it. Are we worried? No, but we are definitely doing something to change it. No doubt about it. Of course, yes. We'll continue with our efforts and focus, which we are hopeful and confident will result in a healthy market share. We believe that we have all the necessary ingredients in place. These things, whether we like it or not, are not a straight line. We do go through gyrations. As you are aware, there has been a period where some of our equity funds weren't doing as well. There has been a significant improvement in the performance. Some of the funds are in top quartile or even in top decile in the last 1 year performance. Even the performance over 3 and 5 years have started looking good and being recognized by our distribution partners as well as clients. We have been making efforts on all counts, including better connectivity with our partners to spread this message. You would have seen some of the other marketing campaigns recently. Simal talked about the Nurture Nature campaign that we did as an ESG initiative, but also it helped us in better digital adoption of our digital assets as well as increase in the flows into SIPs, bringing new investors and new partners into our fold, and variety of other initiatives that are underway, which gives us confidence that over a period of time, you would see improvement in market share.
Okay. And by when do we see our market share getting back to 14-15% like it was earlier?
So as Simal talked about, I think about some of the product gaps, so some of the categories where we were not fully present. I mean, as you know that from 2018 onwards, as per the SEBI classification, there are 4 categories where in equity we have been the largest player. In fixed income, we are present in almost all categories across duration and credit products. And of course, we are one of the largest player on the money market side. But there are few categories like sector and thematic funds, passive products, both ETF and index funds, international funds, and of course some of the fund of fund. Some of these categories, our product bouquet wasn't full, but over the last couple of quarters, we have launched few products. We are going to have some more products over the next several quarters. In fact, Simal can correct me that last quarter we had 2 NFOs, which I don't remember when is the last time HDFCAMC had 2 NFOs in 1 quarter. And both of them met with very good response from our partners and investors. And we believe that all of these efforts, including the performance improvement, would be noticed by the market, and we should be able to see gradual improvement in the market share.
Sure. Thanks a lot. That's it from me.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. On the equity AUM growth, quarter-over-quarter seems to have been decent. Can you qualitatively talk about what kind of market share you are seeing in flows? Is it improving? Roughly what region it is in?
So Aditya, we don't give the number on the flows for the competitive reason. I think over the quarters or years we have mentioned that, we have repeated that point. But overall, as you know that in the industry, flows have reversed. For 9 odd months, industry was seeing outflows. Over the last 3 or 4 months, industry has started seeing positive flows. We believe that I think over the next several quarters, equity flow should remain healthy.
Got it. On the ESOP cost,
specifically, if you're asking about our funds, I think some of our funds managed by the newer fund managers who joined us in last 1 or 2 years, they have seen good traction. Whether it's a new fund that got launched in December quarter, the dividend yield fund, the large and mid-cap fund, focused equity fund, multi-strategy, multi-asset fund. I think some of these funds have seen good traction over the last few months. And of course, we have been highlighting the fact that the performance has improved across the board, and over a period of time, we should see flows coming back across all categories.
Correct, that helps. On the ESOP cost, could you tell what are the expected numbers for full year FY22 and then 23? If you just, I assume those will be pretty clear numbers, but that's what they are. So my modeling purposes.
So I'll take this one. Last call we had talked about the ESOP and the structure of the ESOP, which is a vesting over 3 years.
Right.
right? And one-third are vesting this year. So, and the second vesting is after 2 years, and the third after 3 years. So the costs that you see are upfronted in the first year, because the first year has the full cost of the first tranche, half the cost of the second tranche, and one-third the cost of the third tranche. And since these were granted in February, so one full year gets over in Feb. So this cost that you see in this quarter, logically speaking, you would see the same cost in the next 2 quarters, and the last quarter it would dip, and then the next 2 years would be a lower cost based on the vesting schedule that I just took. So you could, kind of based on this information, do some calculation and figure out what would be the likely cost.
Got it. Okay. And then just last thing, so you mentioned briefly about your own digital investments. Could you talk about how significant they are or how they are placed versus the new digital channels apps like Grow and Paytm Money and Indwealth? So how important is the own acquisition versus through these third-party apps which are getting good traction these days? Thank you.
So I think Simal talked about our refreshed app. I urge you to use the app and have a feel for yourself. We enabled a voice search on our corporate website. We enabled API gateway for third-party integration with some of the tech-savvy distributors. We've got an RM-based access on mobile solution to partners. I mean, I can go on, but as I think I'll say this, that digital is a lot about culture. It's about mindset. It's about people's participation and making it a way of life for your people. It's not only about technology, applications, portal, or the app, but it's about ingraining a culture of automation, a culture of customer centricity, removing every possible friction in their journey, moving from, I would say, a KYC to UIC, I mean, know your customer to understand your customer, enabling our partners to scale up their business. How do we use data and analytics in every part of our business? How can we automate our processes? So all I would say is that, I mean, digital is going to be the backbone of everything we do, entire ecosystem. I mean, even at the cost of repeating some of the things I mentioned, how do we serve our customer? How do we make their journey as frictionless as possible? How do we onboard a new distributor? How do we serve those distributors? How analytics can help them in upselling? How do we deliver our content better? We make it a more contextual and more consumable. So it's about a variety of things and making the organization future ready. We have good digital assets. Over the years, we've been investing. We'll be investing a lot more in that as we speak.
Got it. Thank you.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Hi, thanks for the opportunity and congratulations to the team for a decent set of numbers. And I hope team HDFCAMC is doing well and safe. So I had two questions. The first question was, on the SIP market share. We see, SIP market share has been trending down. And just wanted a color on, what is the driver in the market share fall? Is it the lower number of new SIPs or higher cancellations? Because what we've been seeing in the overall industry number is that there has been significant rise in the new SIPs and the cancellation is plateaued. So how at HDFCAMC we are seeing this similar trend from the company perspective?
So of course, I mean, you would know, Kunal, over the years, I think we've been clearly a leader in the SIP. In fact, more than a decade back, where SIPs were not as prevalent, I think we were one of the largest players in the SIP market. We have worked very hard as an organization to promote the concept of SIP in the mutual fund industry. But I mean, over the years, when you have a cycle which is not in your favor, when performance took a dip, we also saw a little bit of cancellation and less addition of the newer SIPs. As we discussed earlier, when we talked about the flows coming back into equity, we expect the same thing to happen in the SIP book as well. A couple of other initiatives that we have taken off late, which they also include how do we regain our leadership on the SIP front. that's very, very critical component of our business growth strategy. It has always been and will always be.
Sure, I get it. The reason I asked this question, and maybe a follow-up on the same is, one thing that we hear across the industry is that the digital players, be it the Grow, the ET Moneys of the world, the Phone Pays of the world, they are driving the new addition in the SIP. In the last call, we had also, mentioned, talked about it. So how are we pleased with these third-party apps in terms of, getting that new pie of the customers that are entering the market?
So every possible thing, working with all our partners who historically have helped us in building the SIP book, whether they are the banks or the national distributors or the MFDs, large or small, as well as the fintechs are another set of partners for us. So we have been a partner with all of them. As I mentioned that as performance gets noticed, we intensify our effort in better partnership with them as we improve our overall digital capabilities. I see no reason that even in the fintech space why our market share should not be higher than where it is currently. And a couple of other things I think Simal talked about that Nurture Nature campaign, and we were very pleased by the response of investors and our partners. We will be taking more of such initiatives to ensure that we get our fair share of the SIPs. Apart from that, I would also say that it's a lot about market making. One is getting the market share from what we deserve as HDFCAMC, but also while one can talk about the 9,200 crores of SIP flow, but looking at the overall savings pool, that number should be much larger over the next several years. And I think as a leading industry player, we will do whatever it takes to ensure that we not only work on getting the market share from the current book, but also work as a collaborator with other industry players. How do we grow that substantially? So working with millennials, providing the best possible investor education and providing the best possible transaction tool to millennials. Several of them over the last 1 year or 15 months we have seen have got a lot more attracted towards direct investing. We believe that for long-term wealth creation, it's important that they don't take the focus away from mutual fund products, particularly through the SIP route. And whether it's our marketing strategy, whether it's our digital strategy, whether whatever initiatives we are taking on, being more client-centered, being more customer-centered, I think, and moving from a client services to a client delight or a customer delight, I think all of those should help us in helping the industry in expanding that market.
Sure. That is really helpful. Thanks so much. I'll go back in with you.
Thank you very much. The next question is from the line of Prakash Kapadia from Anvit Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. I had two questions. If I look at last 1 year per se in the lockdown, the share of HNIs as well as individual investors in cash volumes has been steadily increasing. It's always been like 2/3 of the overall cash delivery volumes. Typically, what happens when this changes? Because somewhere this direct route of investing market has to rationalize, and when this course correction happens, do we see immediate flows to mutual funds coming soon, or they come with a lag? What typically happens? Because we've seen so many cycles across markets. What typically happens? Do these investors come back to mutual funds and they have a larger role to play in mutual funds because some of them burn their fingers and they come back? Does it happen with a lag? That's the first question. And secondly, if you could quantify the amount raised last quarter through NFO.
Prakash, if I can interrupt, the question is on direct equity versus mutual fund participation by HNIs?
Yes, because currently we are seeing this euphoria. So what happens once this changes? Do we see more participation in mutual funds once this normalizes, once they burn their fingers? Do they come back? Do they come back with a vengeance? They come back with a lag? If you could give some color, that will help.
We've seen that, Prakash. I mean, it's not the first bull market. We have seen in earlier also 2007-8 or 99-2000 or in 91-92. Industry has gone through these phases. I mean, there are always when money making becomes a lot easier. The way it has been in last 12-14 months, a lot of people get attracted to direct investing over a period of time. They realize the benefit of professional management and giving money to mutual funds. We believe that I think over a period of time we should be able to start getting that share. I'm talking about the industry as a whole and of course for us as well. And I think one of the messages that for industry as well as we would be working very hard is wealth creation is not about like, trying to make money on a daily or weekly basis, but wealth creation, if you have seen some of our recent campaigns, is about what we are calling STP, a sound investment plus time plus patience. And we've clearly exhibited that as an industry. I mean, if you look at some of our products which have got 20-25 years of track record and the compounding that has happened, that people who invested 1 lakh rupee 25 years back, they have like 80, 85 or 90 lakhs, or a 10,000 rupee SIP over a 25-year period has become 8 or 9 crores. As we go around and spread that message more strongly and make our UI UX, which they see while trading in the secondary market or investing in IPO, when they see our ease of transaction as easy as that, or as I would say user-friendly as that, hopefully I think we should be able to get that back. But globally, I mean, we are seeing the same thing. There are large number of newer investors who are entering the equity market or rather I would say capital markets. And yeah, I mean, as one of the savings option, as long as we are able to provide a better experience and give our story better, that in the long run it's better you compound your money by giving money to professional fund managers like us, I think we should be able to benefit from that trend. I mean, the trend is very welcome. Honestly, if you ask me, I mean, more than 10 million accounts have got opened in DMAT. I think that just shows that, the interest in the capital market. It's just that how our industry makes our product as appealing to, I mean, our proposition as appealing to these investors, and hopefully we should also benefit from that.
Right. And if you could quantify the amount raised through NFO during the last quarter.
So I think in our asset allocator fund, it was around 1,100 crores. In our BFSI fund, it was 1,877 crores, if I remember correctly, yeah.
And lastly, Vinod, you did mention about, this cycle. So within the cycle, assuming, this cycle has to reverse and normalize sooner or later. So that flows then come immediately. People realize, okay, I'm better off making 15-18% rather than, making that quick buck and then losing everything. So does that happen with a lag in terms of these, individual investors coming back to mutual fund, or it typically takes its own time and effort once the market normalizes and corrects?
I think a part of this, what we are seeing this time is structural. Maybe I think some people think that they can manage, they can invest directly in stocks. There is a good experience they've got. Maybe they may continue. A lot of investors who have entered recently over a period of time, as they make money, they might give that money to the professional fund managers and start refocusing on their own profession or their own business. I think that would be a better utilization of time on a lighter note. I think we'll have to wait and watch. At what is that tipping point where the new mutual fund folios are greater than the new demat accounts. I'll just give you a data point. Between 2017 and 2020, if I remember correctly, our unique investors grew at like 70% or so in absolute numbers. And during that time, the demat accounts increased by like somewhere around 40-50%. So mutual funds were adding more unique investors than the demat accounts where people were entering the secondary market. Now in last 1 year, that 1 year and maybe 15 months
definitely
or so,
changed, right?
that has reversed. We have seen around 15% increase in unique investors, while the demat accounts, are growing at like 50% or so. But we have seen these cycles before, and as I mentioned, as long as our industry collaborate and the message that we have been delivering mutual funds sahi hai, as long as we are able to spread that message. Market is very large. I mean, the under penetration is so much that there would be enough scope for us to grow as well.
Thank you. All the best. Thank you.
Thank you.
The next question is from the line of Prashant Kothari from Pictet. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just wanted to understand the trend of the yields that we have seen. I mean, I understand from FY18 to 20, it was the usual tier compression due to regulations. But why is it that the yields have not really gone up despite equity mix becoming favorable for us in the last quarter?
Are you talking about margin dilution?
No, I'm talking about the yields themselves, the operating revenue, which is 49 basis points. Why it is not kind of going back to FY20 levels while the equity mix has surely become better?
You're talking about the margin compression a little bit. So I think I think over the years we have mentioned that margins are a function of the asset mix that we have, equity or money market. It's also a matter of flow versus the stock. And when I say asset mix, within the asset class also, so when you talk about the debt, credit funds versus money market funds where margins are distinctly different. In equity also, there are products where margins are lower, there are products where margins are higher. Some of the newer funds where money has been raised recently, payouts may have been higher. I mean, the overall trail commission would have been higher versus the stock that we have, payouts would be lower. So it's a combination of variety of things. Also, I think there have been some competitive pressure. You might have heard about some of the NFOs that have happened, and the money has come at a higher cost for the industry. I'm talking about overall, and we have to be cognizant of that fact. And it's a fine balancing for us to look at growth versus margins when we play, I mean, our game.
Would you have any long-term view on where these margins would be after, like, say, 5-10 years?
So, I mean, Piyush would have mentioned earlier several times that, we look at equities more like around 80 basis point or so. In fixed income, it used to be like mid-30s, but it has fallen because the proportion has changed. People have, I would say, a different view on interest rates now as well as on the credit environment, and money has been at the front end of the curve where margins are lower. And of course, I mean, there is a bit of interest coming into the passive fund where margins are lower. I think over the next few years in India, we still believe that active funds will continue to grow, and relatively we have healthier margins than the industry. Even in the fixed income, the bouquet that we have, we believe that our margins can sustain where we are currently. In fact, they were higher some time back, but we hope that at least we should be able to maintain where we are currently. And we are exploring all options. I mean, looking at some of the categories where we are not present. I mentioned in the beginning some of those products when we provide the exposure to domestic investors to invest internationally, etc., through international funds. Over a period of time, we expect that margins could be where they are. But I think globally, if we see the way margins have been under pressure in this industry, with the move happening from active to passive and markets become more and more efficient, obviously there would be some pressure, and I think we cannot deny that. How will we respond? So we will respond through, as I mentioned earlier, on variety of initiatives on the digital and automation side, how we build that better operating leverage on that side, and also exploring some other revenue streams. As of now, almost our entire revenue and profits come from our core mutual fund product. There has been a very strong belief, which I agree that there is so much of a runway for growth in that space given the massive under-penetration in India. At the same time, looking at the global trends and also changing taste of various investors, I think there's we would be open to look at what else we can do on the non-mutual fund side, which includes PMS and AIF, where margins could be better. It's on the drawing board. Hopefully, we should be able to share over the next couple of quarters what we are thinking on that front. So on the core product, the margin range that I gave you, that has been the case over the last few years. We hope that we should be able to sustain, notwithstanding the competitive pressures that are emerging. But over a period of time, if you look at the global trends, then definitely India is on the higher side.
Okay, thank you very much.
Thank you very much. The next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Hi. Good evening, everyone. Firstly, if I look at the equity AUM, sequentially, we have moved from something like 1.66 trillion to 1.72 trillion. Now, this is just a growth of 3% on a sequential basis, where the market returns itself have been pretty strong. Markets, if I look at BSE 500 itself has given some 6-7% kind of returns, or even higher. So does that mean that HDFC would have seen some outflows on the equity side?
Prayesh, the only thing is, I think you are watching those numbers that you mentioned are quarterly average AUM. If you look at the closing AUM, it has gone up from 1654 billion to 1805 billion in the quarter.
Okay.
So if you look at page number 9 of the presentation, on the right-hand side, we have given the closing AUM number, and that would just make it. So it basically, in terms of, if you look at 15,000 odd crores in the quarter has been the AUM rise. So when you're looking at point-to-point market returns, you need to compare with this.
No, so even if you look at that, this still seems to be, especially considering that the market has seen such a sharp increase in flows, there seems to be some disconnect as to whether we seeing lesser addition.
Yeah, we are seeing, obviously we've been and that is visible in the market share, right? So if you look at our market share numbers, if the market share is dipping, so what you're stating is absolutely right.
Okay. And similarly on the liquid side, our market share is dipping sequentially as well. Any thoughts there?
I think we have a significant increase in our market share in liquid. When there was a crisis around March or April, obviously money moves to safe havens and we got higher flows within the liquid fund. But as the corporate requirement of money has gone up over the quarters, the overall AUM in the liquid fund category has come down for us. And now our market share is more reasonable where it should be. It was exceptionally on the higher side last year.
Yeah. So I was talking more even from Q4 onwards, Q4 to Q1 also, our market share has dropped. So any specific reason that you would like to highlight here?
Liquid is very difficult to predict. There's a short-term flows from corporate treasuries, institutions, and some of the other investors. I think it keeps changing in line with the situation in the money market, and it could be specific cases of a couple of investors coming in or moving out on those particular days.
Okay. And lastly, on the other income, there's a very sharp jump. That's primarily because of MTM on equity side, or what was the reason for that?
Yeah, the other income has gone up. Couple of reasons. We've got some mark-to-market gains on some portfolio. Besides that, this whole business of the SL group NCDs that we spoke about, so that has been set to rest. We talked about it, I think, on the last call also. And so we made some gains by selling off collateral on that debenture. So that is also contributed.
Could you quantify the SL part?
I don't think we want to get into quantifying it.
Okay. All right. So I was just trying to get the sustainability of the other income trend, other income.
So on that, if I wouldn't kind of look at this quarter as something that one could extrapolate. There's certainly a number which is likely to sustain because of the way interest rates are at this juncture. So there is a fair amount of one-off here. But beyond that, I don't think we'd like to give any guidance.
But having said that, I mean, you can see our portfolios. I mean, we are 88.5% invested in mutual funds, which is primarily liquid and debt products. 13.5% in arbitrage fund, which again, I mean, you would know where the prevailing yields are, and remaining in debentures and tax-free bonds. So you can look at prevailing yields and you can look at your own estimates on that.
And also look at the fact that the dividend payment is coming up in the next few days, which will take some money off the book.
Got that. Thank you so much, sir.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Hi. Congrats on the quarter. I had a couple of questions. So firstly, regarding, incremental margins being lower than back book margins. Now that has been a story that has been playing out since October 2018. Where are we now in that cycle? Is most of the back book repriced downwards, and probably you'll see maybe just a couple of quarters of downward repricing, or is this going to be a continued trend for at least a couple of years?
So, hey, Piran, we've talked about this a few times before. And so this is going to last for some time. And as I've always mentioned, it's going to be difficult to project, the rate and the time period for which this will happen. The back book, like we've talked in the past, was accumulated in a different dispensation, and the flows are coming at a different price. So till they merge at some point in time, this is likely to continue to happen.
Okay, but is it fair to say that more than half of today's AUM has come, let's say, in the new pricing dispensation era, like in the last 2.5?
Piran, I don't think we can kind of give you any more information than what we've already done on this.
Okay, sure, no problem. And secondly, you mentioned about extra scheme-related expenses this quarter. Could you please quantify it?
No, not really, but some business development expenditure that we've started incurring, for example, things like, SIPs and stuff like that. So that is some additional expense that has happened, but I don't think we'll quantify that. From a competitive perspective, it doesn't make sense for us to do that.
Okay, got it. And just lastly, in terms of, you were speaking about partnering with fintechs and being having your fair share of market share in that distribution channel. If you could just tell us, how do commission rates look like in that channel versus a traditional distribution channel?
So, some of them who have been garnering large amount of new SIPs, they all bring the money in the direct plan. In fact, they have the RIA mode, not in the ARN as mutual fund distributors. Some of them may be mutual fund distributors. It would be a mix of that.
Okay, but if they put in regular plans, are you all offering at par commissions or lower or higher?
At par, I guess, yeah.
Okay, fine. That's all from my end. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Anshu from Edelweiss. Please go ahead.
My question has been answered. Thank you.
Thank you. The next question is from the line of Saurabh from JP Morgan. Please go ahead.
Sir, on the launches, how many more funds are you expecting to do this year, the NFOs?
So we have talked about the categories where we would be looking at newer product launch. So among the 4 categories, multi-cap fund is something that we would be launching in some time. Among the thematic and sector, you would be expecting an MNC fund from us. On the whole passive side, there are a couple of products that we have lined up. The first to start with would be an equal weight Nifty fund, and there are a few more in pipeline at various stage. One international fund, that's in the pipeline. So yeah, we have our hands full for next couple of quarters.
But sir, for the full year, how much should we expect? 4, 5, or higher than that?
I don't know whether it's 5 versus 1. You have seen what one NFO can collect versus maybe many others. It depends on I think it's more about which category of product there, what kind of money can be collected. Yeah, I don't think numbers mean that much. Yeah.
Okay, a fair point. And sir, on this direct part, one is if you can quantify what's the IT budget at HDFCAMC, and second is any sourcing that you get from these platforms is part of that direct sourcing, or will it be part of that national distributors?
No, so platform that comes out of into direct plan is part of direct only.
Okay, it's part of direct. So how much will be HDFC's direct, as in from your branches of that 46%?
So sort of we have not broken down those numbers because it is like multi-channel. Some bit of it comes on our website, some bit of it comes through our physical branches, and then after the RIAs as well as the fintech platforms.
Okay, but the fintechs will be like, can you give a rough range of where that number will be? Will it be dominant part of this part, or?
Of our current book, not dominant part for sure. Because I think the fintech SIP creation is a more recent phenomena than an older one, and our book is like much.
No, sir, of the incremental.
On the incremental side, no, I don't think. Yeah, not in value, honestly. Yeah, numbers maybe.
Okay, and the technology IT budget will be how much, sir?
I'll give you the amount of money, and as I mentioned, I think part of it is capex, part of it is revenue expenditure, part of it is like partnerships, part of it is like our own development. It's just a combination of various things. So I think I won't be able to give you an IT budget as such within the overall expenditure. Yeah.
Okay, and just one final question, sir. We have seen some of your competition pushing a lot very aggressively now into passive ETFs, and you have Zerodha guys now launching a passive ETF, and we have seen what they've done with the broking industry. So, what's your view on this passive business now? Would you be looking to expand this more aggressively, or, so how would you think about this passive ETF now?
I think if you look at the overall size of the industry, it's still small. And you talked about one player. I think mentioned in the last call, the more the merrier. I think the more participants will only help in expanding the market. The market is very small. All said and done, we still have like 2.5 crore unique investors in India and 1.35 billion people. We have set a very audacious, I would say, a mission for ourselves that we want to be the wealth creator for every Indian. So we have little over 5 million unique accounts. We think we have a very, very long way to go. Some of them will come in active funds, some of them will come in passive funds, some of them will come in solutions-oriented product. I think in India, different households will have different needs. I think at our end, the way we are looking at business is not looking at the way, the asset managers would look at, active versus passive, or equity versus fixed income, or mutual fund versus AIF, PMS, or within the distribution, direct versus with distributors, within distributors, banks versus NDs versus MFDs or RIAs, or looking at T30 versus B30, so on and so forth. I think at our end, the way we are thinking is like there are tens of millions of savers in India who are yet to get the right kind of product which they can use for meeting their financial goals. As long as we are able to provide right kind of solutions to these people by understanding them better, working with our partners or working with digital platforms, over a period of time we should be able to grow. Surely, passives have grown tremendously globally. I think there is a lot of scope for that product to grow in India as well. In fact, we earlier mentioned about we would also be launching a couple of products to fill our product bouquet. But whether this will significantly dent the growth potential of the other segments of the business, the answer is no. Will it really expand the market? The answer is clearly yes. And I think I mentioned that line last time that large number of people in India are yet to meet the market. They don't get up in the morning, how do I beat the market today or in next 6 months and 1 year. So I think we are very clear that I think we are going to put customer at the center and how we can help them in meeting their financial goals, meeting their life goals. And as long as we are able to do that, what product and how we construct that solution, is something that I think collaboratively we'll all do in industry, and newer players who will bring new innovation, whether in terms of product, in terms of delivery, in terms of providing different experience to investors. They are all welcome as part of the industry. We'll all work together. At our end, I think the mission is absolutely clear. We want to be the wealth creator for every Indian, and we believe that this product has a lot more potential to grow, and we need to reach out to many more investors than what we have reached out in last 25, 30 years as an industry.
Got it. Thank you, sir.
Thank you. The next question is from the line of Nitin Jain from Fairview Capital Partners. Please go ahead.
Hello. Can you hear me?
Yes, Nitin.
Yeah. Thank you. Based on the data that the company has provided in the last 3 annual reports, so it seems that it is continuing to lose its distributors. So, for example, in FY19, you had around 5+ distributors on your panel, which dipped to 70,000 in FY20, and now we are down to 65,000. So, I've asked this question before as well, but all I've got is that the company values its distributors. So, just wanted to get your perspective on why people are leaving us compared to what the listed peers are reporting, an increasing trend of empaneled distributors.
I think we are back to more or less where we were in terms of number of those distributors. In between, there was a trend where some of these distributors, if I remember correctly, were moving to platforms like Prudent and NJ and all because, I think aggregating technology and the other IT backbone is available. You get better service. So some of them kind of merged with these platforms. So maybe the number may have gone down, but then newer distributors are starting and our numbers are there. In fact, I'm happy to state that in our sector fund, the BFSI fund, that we had more than 10,000 MFDs participated in that. So I think we have a fair, I would say, acceptance among that category of distributors.
Okay. No, the reason why I ask this is from the time since SEBI has banned, upfront commissions, HDFC has been seeing a consistent decline. So, does it have anything to do with that? Because the company straight away passed on to the distributors.
No, so I think there are 2 ways to look at it. One is basically the 70,000 kind of a number that we are talking is the entire universe. The active distributors, the list is obviously much smaller. And I think what Navneet referred to, saying that in our latest BFSI NFO, we saw more than 10,000 distributors participating, which is a very, very large number. So nothing of that sort. So in terms of, if you look at, and I think that is the point that Navneet made, some of the smaller distributors have actually moved to platform and for reasons of efficiency and cost-benefit analysis.
Okay. And the other significant trend that seems to have played out in the last couple of years is the rise of passive investing. So if you see, they have risen from somewhere around 8 to 9,000 crores in 2010. They are close to 2.5 lakh crores, like the entire passive AUM. So I've tried to, get the company's perspective earlier as well, but it was kind of the only response was that no, it is still a very small part of the entire industry. But if you see in the last 3 years, it is the fastest growing section of the industry as well. And some of our peers have like 35-40% market share in that. So what is our strategy? I mean, do we want to wait some more time and then take aggressive corrective actions? How is the company planning?
So let me do one thing. I'll give you some data and then Navneet can give the strategy part of it. So the number, if you look at as of June end for the passive ETFs is 3,20,000 crores. Now out of these 3,20,000 crores, the 2 government, quasi-government owned entities, they add up to close to 2 lakh crores, right? Slightly actually more than 2 lakh crores. And that is basically Government of India, EPFO money and some of the other provident funds which tend to mirror image the EPFO. So the large part of that money, where we talk about out of 3,20,000 crores, 2 lakh crore goes to these 2 asset management companies. And as of now, all of that money has been allocated to both of those in ratio of 3:1. That's point number one. Second is, so this is the other close to 40,000 crores is the liquid debt in the Bharat Bond ETF. And out of that 40,000 crores, close to around 34,000 crores is the Bharat Bond ETF, which is again government-owned entities, the PSU fixed income capital raise, which has been done through one asset management company. We did not participate in that bid for economic reasons. Then you have some bit of money in the CPSE and the Bharat 22 ETF. Again, that was government's disinvestment program. Close to around 22,000 crores has been from that. Now government has come out and made a statement. So the divestment secretary has made a statement that this would no more be the preferred route of further disinvestment. Then there is a gold ETF which is close to around 16,000 crores. We have a fairly healthy share there. We are the second largest in that space. So if you look at all of these numbers, so yes, the number seemingly looks very large. Having said that, if you kind of break those numbers and look at the target market segment, does not necessarily really kind of fit into the way we look at things. Now, when you look at the retail participation in passive, and that tends to happen through index funds rather than through ETF, it is close to around 25,000 crores of AUM in index funds. Out of that 25,000 crores, we have a AUM of 5,600 crores. So we are literally kind of more than 1/5 of that market. And as Navneet mentioned earlier, we recently got an approval from the regulator to launch an equal weight index fund, which we would be launching it maybe sometime during the course of this quarter. And Navneet can throw more light on the strategy part.
No, I think you talked about it, and I mentioned earlier that there would be growth in both active as well as passive as we see India evolving. Even globally, I mean, we mentioned earlier that passives have done very well in terms of incremental growth. But my sense is that over the next few years, even globally, it may be a little contrarian view that I think active is going to make a strong comeback. In India, I think there is strong growth potential on both sides, passive as well as active. I think even at the cost of repeating maybe second or third time, I would say that the way we would look at ourselves is not like active versus passive or, I mean, in those terms, but like putting the customer at the center and then using our capability as an investment manager, right? I mean, we can do active, we can do passive, we can do, whatever it comes to investment management, put that along with our risk management and the overall product capability. And then using the power of data and analytics and providing the right kind of contextual, consumable content, whether it comes through any kind of channel, whether the traditional channel or the digital platform. The idea is that how do we reach out to more number of savers and provide them the right kind of solution with the help of our partners or the digital platforms. That's the idea. If it means like maybe investing a little bit more in passives than what we have done historically, we will surely do that.
Nitin Jain, you're on mute. May I request
that's it for me. Thank you.
Thank you very much. The next question is from the line of Madhu Gupta from Quantum Asset Management. Please go ahead.
Thanks for taking my question. So basically, I wanted to know whether HDFCAMC has any scope for further reducing its, for deriving operating leverage benefits going ahead. And if that is so, then in which areas do you see the savings coming in from? And the second question would be the latest regulatory, as for the new regulation where the key management, under the compensation of the key management employees, at least 20% of that should be going to the mutual funds in which they are managing. So is that going to impact your employee cost in any way? So any color on that?
On the first, on operating leverage, the business inherently, the asset management business globally is known for its high operating leverage, right? A new fund manager at our end is, let's say, managing 5 or 10,000 crores of asset that AUM doubles in next few years given our franchise. Would we have another fund manager for that? No, the same fund manager is managing that, the same set of branches, the same set of the overall cost which we have. Of course, a part of it will be variable. Let's say the money coming in from the distributor, there is a cost attached to it, but our margins obviously there is if you look at the overall margin, there is obviously a positive operating leverage. Having said that, I think Piyush has been highlighting it over the last couple of quarters that some of the cost reductions that have happened, particularly I think the organization ensured that during the tough time of last 1 year, a lot of cost rationalization happened. Some of those costs will come back as we start looking at newer growth avenues and expanding the market and launching the new products, investing in marketing and business development, investing in IT and technology, in the technology and digital, etc. So some bit of cost will come back. Having said that, structurally, if your question is about the operating leverage, yes, inherently, this is a business with a very high operating leverage.
So the reason I'm asking is if you look at HDFCAMC, the cost is as compared to peers, you're already on the quite low. So is there a scope for further reduction in that, or this is the optimal which you can reach, and beyond this there's going to be an increase? That is the.
I think the more important, Madhu, would be how the flows kind of come back and the market action on the revenue side, I think, rather than on the focusing on the cost side. I think in the last call we mentioned that some of the cost reduction that we saw last year in FY21, 2021, they were on account of reduction in travel, in business development, some of the other overheads, etc. Some part of this cost is going to come back, and we wouldn't want to hold that on, because I think we would like to invest in growing our business. So some of it may sustain. I think the cost rationalization that has happened as you use technology better, some of it which could not be spent last year, for example travel, I think would come back at some point in time. But structurally, again repeating the same point, if you're asking about operating leverage, yes, it is there as the size keeps growing. So for us, more important would be how do we grow the revenues and how do we grow the AUM.
Got it. And regarding the regulatory change where now the compensation, 20% of the compensation should essentially be in the funds which the key management personnel are managing. So would that kind of have any impact on your employee costs? Do you see any kind of
I think it's
that change?
Today in the AGM also our chairman talked about it. He applauded, he praised the regulators for bringing this in, and he mentioned that we would be happy to implement. Of course, he talked about some bit of flexibility that can be given to the asset managers on how to implement it, but otherwise I think even otherwise, most of our employees, as it is, would have their money invested in the fund house or in their own funds. So I don't think it will dramatically change the way people look at their investments, and maybe our employee costs, not necessarily. All I think the chairman asked for was if some bit of flexibility can be given. A younger employee may have a different kind of risk return expectations or a risk profile, or let's say different employees would have their own different financial needs. But otherwise, in general, I think it's a welcome move, and he applauded it.
And to your pointed question, will it affect our employee cost? No, it won't. No.
Okay, that's it from my side. Thanks.
Thank you. The next question is from the line of Venkatesh Sanjeevi from Pictet Asset Management. Please go ahead.
Yeah, hi. Thanks for taking my question. Just a gentle observation on the domestic mutual fund industry is that a lot of products get sold by distributors based on, let's say, near-term performance, maybe 1 year or maybe maximum 2 years or so. What was done well in the recent past are easy to sell and get sold. Even if you see the way international funds are getting flows now, or some of the segments have done well getting flows, it seems to be the case. So the question is, how can this kind of change? Can other parameters like risk or turnover or the other aspects of a fund be highlighted? Are AMCs taking steps to sort of sell the products on things apart from just a near-term performance? you think it is feasible to get that sort of maturity over the industry as well?
So that's a great point, Venkatesh. You have made that people focus so much on, I would say, a fund alpha on the short-term side rather than looking at the investor alpha. More important is how do you meet investors' goal? How do you create the alpha for the investors' money over a long period rather than keep chasing last 1 year or 3 years performance? And there are a number of studies, I'm sure you know that better, where I think churning money based on the recent performance doesn't lead to better outcome for the end investor. I think over the years we are seeing a good number of our partners understanding that aspect. I think fund houses along with the distributors, along with all the other stakeholders have been making a lot of efforts on that front to highlight the importance of staying invested for the long term. Initially I talked about our newer marketing campaign about the STP, it's sound investment plus time plus patience, and not trying to chase the fad of the season, which really create wealth for you over the long period. And we hope that as markets become more mature and investors as well as the distributors pay a lot more attention to long-term performance and long-term wealth creation rather than keep chasing the short-term performance.
But do you think AMFI as a body needs to kind of, the way the Mutual Fund Sahiye campaign came about, kind of build something on that side and try to build awareness instead of just 1 or 2 funds trying to do this?
No, I think everybody in the industry, and I must compliment every player over the last several years, have been working very hard to highlight the importance of long-term investing, highlight the importance of staying disciplined, the whole SIP campaign, that how the staying disciplined and keep investing on a monthly basis over a longer period is better than chasing the short-term market movement. I think it's been happening. The entire industry is doing it together. Can we do more? I mean, of course, everything. That's true for everything that the industry can do relative to whatever we are doing. And your point is absolutely right that all the stakeholders need to work together to ensure that investors look at like creating wealth over much longer period than trying to chase short-term performance.
Right. Okay. Thanks for that, and all the best, Amit.
Thank you. The next question is from the line of Mr. Mukherjee, private investor. Please go ahead.
Yeah, thank you for taking my question. Basically, 90% of my mutual fund holding is in HDFCAMC, and 90% of my portfolio shares is also HDFCAMC. So I am viewing this very carefully, and what I have observed is that compared to other AMCs, HDFCAMC is lacking some aggressiveness in their portfolio. For example, if I see SBI Focused Fund, if I see Axis Focused Fund, they are having significant weight on Avenue Supermart, significant weight on Alphabet, and those companies which are growing very fast. Whereas if I see HDFCAMC portfolio, there are funds which are holding Jagran Prakashan and such sort of stocks in their portfolio. So my question is, if HDFC wants to go ahead with value-based investing, this is perfectly fine. But why can't HDFCAMC offer aggressive portfolio? Because I as an investor, I as a customer, if I want to invest a part of my money in aggressive funds, then I have to go to other AMCs because HDFCAMC is not offering me any portfolio of that sort. And what is your thinking on that? Because that is my first point.
So, if you look at, I think I mentioned it in the beginning, if you look at the longer term track record of several of our funds which have been in existence for a very, very long time, I think the performance speaks for itself. There could be cycles in the short run, but more important is the way money has got multiplied over the years. We talked about our FlexiCap fund, which used to be HDFC Equity Fund, or the HDFC Balanced Advantage Fund, which was a different name but the same product. over the years the kind of performance that is delivered. At any point in time, one can always pick up, like let's say the one or two names. I wouldn't comment on the individual stock name, but they don't reflect the aggressiveness or the conservativeness. I think more important is remaining true to the label, remaining true to the fund philosophy that you have, to the mandate that you have, and what you have communicated to the investor. And that is what we have exhibited over the last couple of decades. And we see no reason that most of our funds won't be able to deliver that kind of performance that investors expect from us over a long period. I think our focus has always been on risk-adjusted returns. There are various kinds of products. The investors who are looking at, let's say, a small cap fund, they can enter or they can invest in a small cap fund versus who's looking at a concentrated portfolio of a couple of high conviction ideas. They can look at a focused equity fund. Those who are looking at a more diversified across market cap can invest in flexi cap. Those who want a little bit of fixed income within the portfolio can look at balanced advantage or the hybrid equity fund. And within that, different fund managers have got different investment styles. And this whole value and growth and quality, and I'll just say that, I don't know who said this, that every investing is value investing, because when you don't say, I do wet swimming, every swimming is like you get wet. You in investing, you look for value which is more than what you are paying today. So different managers have a different lens of looking at the stocks and a different style, but I think all I can say is that the history has clearly proven that we have an investment strategy and investment philosophy and investment process, and the people who have been able to demonstrate high quality, I would say, performance over a very long period of time.
Thank you.
Thank you very much for your business.
And thank you so much, and really appreciate your confidence in the AMC. Thank you so much.
My second question is, how do we incentivize the fund manager? Because if I see I have my fund in all the small cap, mid cap, whatever you say, I have my investment in all these funds. But when I see their portfolio, there is a significant amount of overlap between all these funds. So I want to know, how do you incentivize fund managers? Because if the AMU is increasing, it is increasing because of maybe inflation or maybe new fund that is coming into that particular fund. So what weightage you are giving to automatic increase in the AMC because of inflation, and what weightage you are giving to new fund that the investor is devoting or putting into that particular mutual fund? Because that shows the trust that I am having on that. Suppose if I believe that focused fund will do very good, HDFC focused fund will do very good, then I will pour in more money into that. So what is my share of wallet? How much of that is coming into the incentive system? How is it getting tracked?
I didn't get the question.
Is it about fund manager incentives? And Mr. Mukherjee, if you don't mind, maybe this would not be the best platform to discuss this, but if you're okay, if you can just drop in a mail to us or give us your contact, we'll call you and address this query of yours.
Okay. And my last question is,
yes.
I see on YouTube, although we have lot of trust on HDFC brand, everybody is positive about it, but there are several YouTube videos which are talking negative about the HDFCAMC, its fund managers, its performance. Now, if a small guy from a small town is viewing those YouTube videos, and he is also viewing the video of some other competitive AMCs, he may get biased. How do we counter that?
You cannot respond to the millions of tweets and millions of comments on the social media. That won't be possible for a company, but I think the proof is in the pudding. So, we can clearly see the recent NFO or our Nurture Nature campaign or some of the other flows. The response that we get from smaller towns is highly encouraging. I think our brand is highly respected across the country, whether it's large town or a small town. And I think the people look up to us as a highly trustworthy brand. And I don't think that some comments here and there really impact investors' decision making.
Thank you so much for your comment.
Thank you. I mean, you
what
are
I wanted to bring.
For us that 90% of your money is with our fund house. I'm sure there would be many other investors like you, and I hope there are more and more investors like you who have that faith in an AMC which has put the purpose at the center of everything that we do, which is to be the wealth creator for every Indian.
Thank you. Thank you so much.
Thank you very much. The next question is from the line of Utkarsh Solapurwala from Damos Capital. Please go ahead.
So recently, Navi has launched its index fund at a very low TER ratio. So going forward, if many other digital only AMC will launch that at a low TER, there would be price-based competition. So what is your view on the price-based competition in India?
I mean, in our industry, competition has always been there. I mean, it's not something new, but of course, I think there are innovations in products, there are innovations in terms of delivering those products, etc. As I mentioned earlier, that given the opportunity in India in this industry, the more the merrier. More and more of these participants will help in expanding the market. When you just have 2.5 crore investors, I think if a lower fee for one AMC is, I mean, if they are able to bring in many more investors, I think as an industry participant, I would welcome that. Having said that, as I've been repeating a couple of times, for us, it's like how do we provide the right solution to each investor and each of our partners in meeting their financial goals. We wouldn't really look at one particular product that has got at a much lower cost. There would be various things that every investor would need. And it's not only about, I mean, if history is any guide and every investor's experience would clearly state that it is not about saving few basis points here and there that really helps in meeting their own life goals or financial goals. I think it's about the overall package that an AMC or an asset manager delivers. I think we always believe that together with all partners, both the mutual fund as well as the other stakeholders should work on enhancing the investor alpha while we as a manufacturer continue to work on delivering better fund alpha. And I think that's a more important part.
Okay.
For us, I mean, we mentioned it several times. Our business over the last 20 years has got built on this premise that we aspire to have scale. We are one of the largest players. We aspire to have quality, which is reflecting in our asset mix and in the way we source our business, the way we have built our business, and of course, we want industry-leading profitability and wouldn't really sacrifice one for the other. And all of this with purpose at the center, which is to be the wealth creator for every Indian.
Thank you.
Thank you. The next question is from the line of Hiral Desai from Anved Portfolio Managers. Please go ahead.
Hi, Navneet. Am I audible?
Hiral, may I request you to speak a little louder, please?
Can you hear me now?
Little better.
Yeah. No, so I actually had a question on the cost side, Navneet, but you sort of answered that in one of the earlier question, and I think you covered it fairly in a detailed manner. But just wanted to understand out of this sort of the total 10 basis points of cost that we had last year, what proportion of this would be variable in nature? Just a ballpark number.
You are saying 10? Okay. Yeah.
In the past, we've talked about it that roughly out of our cost, between 20 to 25% are variable.
20 to 25%. Yeah. Got it. And lastly, for Piyush, are there any other collaterals still sitting related to the SL NCD, or it's done?
No, I mean, from a financial perspective, there's nothing else. It's pretty much done.
Got it. Perfect. Thank you.
Thank you. The next question is from the line of Kunal from Banyan Tree Advisors. Please go ahead.
Hi, thanks for the opportunity again. My question now relates to, we have seen a lot of traction in the national pension, business after, PFRDA changing the realization there, and HDFC being the largest private player there. Can you throw some light on that business and the long term, from a very long term perspective,
We are, if I'm not wrong, at 18,000 crores of AUM now. How do we look at that market? Because a large part of that market is locked with PSUs. How do we, look at from, say, 5 to 10 years perspective?
So, that's part of one of our group company. I'm sure you would have an opportunity to ask them specifically about that company and that business. But in general, of course, in India, if you look at the overall savings pool, if you look at the demographics, if you look at the need for investment product, I think all investment products will coexist. I think mutual funds have a play, pension products have a play, some of the other products have a play, and everybody can coexist, and there is enough opportunity for all the players. But specifically on that business and how it's evolving, I think I may have a view, but it's better you ask HDFC Life.
Sure. Thanks. That's all. Thank you so much. All the best.
Thank you. The next question is from the line of Kapil Agrawal from IDIS Capital Advisory. Please go ahead.
Hi. So my question is regarding, your flagship equity fund has seen significant growth in the last 1.5 years, and that is made up for some underperformance from 2015 to 19. But when it comes to raising capital, some of your competition has been quite aggressive, and they've fared much better in this regard. So how are you looking at growing your AUM, both in terms of inflows and new fund offerings? Can you give us some color in where you're targeting also?
So first of all, on the performance, as you mentioned that there were some time when there was an issue in terms of performance of some of the key schemes, and we have seen a material reversal on that front. And as I mentioned earlier that some of those schemes are now in top decile. In fact, some of them are in top quartile in 1 year, and of course even 3 and 5 years has started looking good, and it's being recognized by our distribution partners as well as clients. Of course, it takes a little bit of time for them to recognize the reversal, but we are hopeful that the work that we are doing in giving that message and people have been noticing it. And have we done anything differently? Not honestly, not really. What was not working in the last couple of years is now working. So our investment team has seen few such cycles in past, and that makes them stick to their conviction because they've seen some of these cycles before, and this has been like another cycle. And we are very happy to state that on those positions or on those convictions have got vindicated. It does take time for the market to recognize this fully, but we can today confidently state that things are improving on the ground. I'll also mention, I think in the beginning we mentioned about the style diversity, which even some of the earlier calls we have talked about. The whole idea of achieving style diversity is working out reasonably well. So some of the newer fund managers are now managing almost 15% of our AUM, and some of those funds have seen traction. We also have a good product pipeline in place, while we expect flows to start increasing in the core flagship products, which have one of the best-in-class long-term performance track record, though they went through a cycle of underperformance and now coming back.
Could you highlight something regarding the new fund offerings? Any particular markets, any particular types you're targeting? Could you highlight something? Yeah.
Maybe you missed it earlier. We have talked about the categories where our presence has been less. I think after the CV classification, as far as the core categories are concerned, across equity, fixed income, gold, we have our product basket almost full. We would be launching a multi-cap fund at some point in time, of course, subject to all the approvals and other things in place. We would be launching few passive funds, maybe some on index side, some on the ETF side. We would be launching some international funds. We would be launching some funds on the sector and thematic side. Last quarter, we had this NFO of banking and financial services, and some more on the thematic and sector side are in the pipeline. Having said that, I think I might have mentioned this on the last call, my first call, that I have always praised and appreciated HDFCAMC for one thing, that this AMC would never launch a product because this is the fad of the season. unless the investment team believes in it very strongly, unless we believe that at any point in time, at least a segment of investors would have the need for that product in their overall investment portfolio, unless we see a sustainability as well as the longevity of that product. We wouldn't launch just because we want to do an NFO. I mean, we have never done that and we would never do that. But wherever there are product gaps, we would fill that over the next several quarters or years.
Sure, thank you. I have one last question. And you've touched upon this before earlier in this call regarding some of the newer entrants to the market investing directly. How are you looking to target these people? Could you highlight something, any particular steps that you have taken or going to take to target these markets?
So I think our belief has always been that partners are very important. This is a large country. There are, hundreds of towns and 600,000 villages in India. There are 1.35 billion people across the country. If you look at the number of advisors today, there is like one for 17,000 people. Investing is not only about an ease of transaction or doing it. It's a lot about behavioral aspect, and that's where the importance of a good advisor or a good distributor is very critical. To do the hand-holding at the right time, that in the month of March 2020, you don't move out of equities and maybe the other way around. So we strongly believe that partners have a big role to play. Having said that, there would be investors who will kind of do it yourself DIY, just like they do for several other aspects in their life. They would like to do even investing on their own, and then we would have the best-in-class platform for those as well. But our fundamental belief is that partners are important for us, and there is no reason to believe that they won't remain important for our business to continue to grow.
Thank you for answering my questions. I wish you all the best.
Thank you. The next question is from the line of Franklin from Equentis Wealth. Please go ahead.
Yeah. Thanks for taking my question. So right now, the one of the main issues which is there in our minds is the shift that is happening between the increasing in the number of demat accounts and the mutual fund accounts. So right now also we have discussed this a bit in the call as well, that when the market increases, you actually see a lot of increase in these demat accounts. So my question is actually based on your experience and in the past, what percentage of when the market turns around or even remains subdued or even goes negative, what percentage of these incremental new additions that are happening into these demat accounts actually come towards the mutual fund category?
I think we quoted that number earlier, that between 2017 and 20, if you look at the proportion of the new accounts that got added by the mutual fund industry versus the demat accounts, I think that was like mutual fund industry was adding a lot many more unique investors than the new demat account. Now that trend has got reversed over the last 15 months, variety of reasons. Of course, markets have been favorable to people. The work from home may have made a difference. Maybe some of the platforms which have made investing into secondary market a lot more easier. I'm sure that may have made a difference. And of course, some of the millennials and some of the younger investors are liking that experience. And it's not only in India. I think it's been a global trend. The so-called Robinhood effect. Now, how do we respond? I'm talking about the entire industry and for us as well. So I won't look at it as a challenge. I would look at both. Of course, whether if everybody thinks that making money is so easy and they can trade and can create wealth over a longer period of time, that's concerning. The other way to look at it, it's a big opportunity. It just shows the interest in the capital market. It just shows that the investing habits are changing. I think some of the earlier ways of investing versus maybe people are thinking that capital markets are a better place to put money. So from that perspective, it's an opportunity. So how do we need to respond, both as an AMC as well as an industry? And I would say that, if you look at why this trend is happening, keep aside the near-term market movement, etc. and all, I think we need to, as an industry, do a more, I would say, faster digital adoption, provide a better user interface, a better user experience when they are investing in mutual funds relative to, let's say, when they are investing on their own through some of these platforms. We need to do a lot more, I would say, deeper focus on investor education. How do we highlight the importance of long-term wealth creation that happens through the power of compounding by remaining disciplined, doing, setting the right goals, doing your asset allocation, remaining disciplined across market cycles, and that's how the wealth gets created, and spread that message in the language that these people, I would say, absorb better. We also need to redesign the product and marketing strategy, that how do we deliver this message, as I mentioned a while ago, that in the I would say in the language that they would prefer, we make that content a lot more, I would say, better consumable, better contextual. And of course, the right kind of partnership, that some of these platforms which have been able to attract a lot of these investors, they themselves have mentioned that large number of their investors don't make as much money as they can make by just investing in fixed deposits, right? I'm sure you would have heard or read their comments, because they have the experience of what their investors are doing by trading in the market. So at our end, from a mutual fund industry perspective, or as an HDFCAMC, we need to partner with them and ensure that our products are there for investors to see with the right kind of messaging and right kind of packaging. I think if we do all of this together, I have no doubt in mind that next few years we would also be able to attract a lot of these investors into the mutual fund fold.
Okay. And my next question is on the equity AUM share, both for you and as the industry. If you see the trend, the longer term trend, the share of equity AUM has been constantly, increasing, and that's probably largely got to do because our interest rates are declining on a structural basis. So probably maybe 5-10 years down the line also, it is very much possible that the interest rates may not hit the peak, and it makes equity investing much more attractive compared to debt investing. So is it possible that, we could see our equity share moving to somewhere around 65%, 60-65% kind of a level, if we have to just take a slightly longer term view?
We would love to see it that way. If you look at the profitability, but that's not how the world works. So let's say, even in other countries where interest rates are very low, is it that people only invest in equity? Even at negative yields, there are trillions of dollars invested in bond funds and money market funds. Different investors have different income needs, different investing needs, and I think we need to have products for all investors. In India, if you look at the total size of the fixed deposit market and some of the other fixed income products like bonds and post office and all of that, that's like a large market, and there also I think mutual fund have a good proposition to attract those investors. So I think, both will grow. I don't see any reason that only equity will grow and there is not much of scope for us to grow on the fixed income side. I think on the retail side particularly, there is tremendous scope for us to grow in individual investors' book.
Yeah. Thanks a lot.
Thank you. Ladies and gentlemen, we'll take the last question from the line of Nitin Jain from Fairview Capital Partners. Please go ahead.
So just to follow up, net of the increased ESOP expenses, what would our operating margins have been, like in basis points?
36, 37? I think it's 37. 36 and a half.
37. Okay. And Navneet mentioned some time back that the funds managed by the newer fund managers are getting increased traction. So is it possible to spell out the funds?
Sure, we can. So it is there is a gentleman by the name of Amit Ganatra. He manages the HDFC Capital Builder Fund. He manages the HDFC Multi-Asset Fund. He manages the HDFC Asset Allocator Fund of Funds. He also now manages the HDFC Tax Saver Fund. Gopal Agarwal, who's one of the other managers, he manages the HDFC Focused 30 Fund. He manages a fund called HDFC Large and Mid Cap Fund. He manages the HDFC Dividend Yield Fund. These are the funds. Focused 30.
Yeah. And now Anand Latta would be managing the Banking and Financial Services Fund, another fund manager where, of course, that fund hasn't grown, but I think, maybe if the investment cycle turns, then Rakesh Vyas, who manages our infrastructure and housing opportunity funds.
The line for the participant dropped. I now hand the conference over to Mr. Navneet Manot for closing comments.
Thank you so much for being with us, and I hope you and your loved ones are doing well. Stay safe, stay healthy. Thank you.
Thank you very much. On behalf of HDFC Asset Management Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.